Okay. All right. Good afternoon. Welcome to Sikich's webinar on fraud considerations and financial and compliance audits for not-for-profit organizations. I'm Kate Burian, a member of Sikich's forensic services team, and I'm joined by Leary Morris from Sikich's not-for-profit audit team. Some housekeeping for you. Questions can be submitted throughout the presentation by using the questions tab at the top there. If we don't get to it during a presentation, we'll be happy to follow up with you. A copy of this presentation is available in that handouts feature also at the top. And then for CPE credit, you'll have to answer 3 polling questions and then take a feedback survey that'll pop up at the end. Then we can move forward a little bit. Again, to introduce ourselves, I'm Kate Burian, a CPA and a certified fraud examiner. Before I was a forensic accountant, I was an auditor for various types of organizations, including not-for-profits. My forensic work has focused on employee embezzlement investigations, for which I will share a few stories in this presentation, as well as internal control assessments to help prevent fraud, other types of investigations, litigation support, business interruption claims, etc. Larry?
Yep, and I'm Leary Morris. I'm a director here at Sikich. I service the not-for-profit industry, specifically in audit. I've been working with not-for-profit organizations for the last 15 years. I'm so excited to be here. I'm joining Kate because I've had the unfortunate ability to work with a couple nonprofits the last couple years that have experienced fraud, and have taken a little bit of an interest in forensic as well.
Okay, so our agenda today includes starting with an overview on fraud, as well as some stats and trends, auditor expectations versus reality, and why an auditor is not charged with finding fraud, but is often expected to. So we'll discuss what an auditor's responsibilities are. Fraud risks for not-for-profits, including the conditions that make them susceptible to fraud. We'll also discuss some example investigations, like I alluded to. We'll review our recommendations on enhancing internal controls, and then follow up with some fraud training resources and tools. So we'll get started with a fraud overview. I always like to include the definition because fraud really is intentional, and we want to distinguish it from errors or just plain old incompetence, which comes up more often than you would think. So again, fraud being intentional is a knowing misrepresentation of the truth or concealment of a material fact. It is widespread. It affects all organizations of every size in every industry. So every industry needs to be concerned about fraud's effects. And finally, it's very costly. Fraud affects the global economy over $5 trillion annually. And that statistic is from the Association of Certified Fraud Examiners. They have a report to the nations that they put out every 2 years or so. Most CFEs you see will provide statistics from that report fairly often. So that's where they get that. So what are the 3 main types of fraud according to the ACFE? That is asset misappropriation, or more simply, theft; corruption, which includes things like bribery, kickbacks, conflicts of interest; and finally, financial statement fraud, which is manipulating the financials for a desired outcome. So maybe a need to meet debt covenants or show a certain level of earnings, or to show that you have that like 80-20 ratio on your statement of functional expenses, that kind of thing. So again, asset misappropriation being the most common schemes that we'll see. This just includes like your employee embezzlement or vendor fraud. Your cash is taken or disbursements are sent to the wrong place, either a fake vendor, a ghost employee, that kind of thing. That is the most common thing I also see as well. And those are the main engagements that I work on. Next, we have the fraud triangle, which, if you're familiar with that, has 3 conditions on why people might commit fraud. So first is your pressure or motivation. That often comes from someone's personal life, or even just certain job goals or incentives. If you're somebody, say, working on a commission, may be more apt to feel the pressure to get to a certain amount. Personal life pressures could include high levels of debt, lifestyle expectations, a sort of addiction like gambling or shopping, that kind of thing. Our next pillar is rationalization, and that's trying to justify fraud as an acceptable fact considering the circumstances. So you'll see there, you know, I'm only borrowing the money and I'll pay it back, or I work hard for so little pay, so I deserve more, kind of thing. And then finally, we have opportunity. So that's usually using someone's position of trust with a low risk of getting caught. And so this is the area where organizations have the most control over preventing somebody from committing fraud. So if somebody can close gaps in their internal controls, have less windows of opportunity for a perpetrator to take advantage of, this is the area that organizations can most devote their attention to. And then most fraudsters or perpetrators display at least one of the following common behavioral clues. And so living beyond their means is the most common one, and it's also the one I see a lot too. Someone gets used to a certain lifestyle, so they have to keep up their fraud. One of the most egregious instances I've had of someone living beyond their means was a part-time payroll clerk with a shopping addiction for luxury goods and a propensity to cover expensive vacations for their friends and family. And so they often tried to explain it away, saying, my spouse, has a great job. I know somebody at Disney that can get us, a good rate on these vacations, that kind of thing. So they try to explain it away. But again, this person was making less than $50,000 a year and had a lifestyle not consistent with that. So again, a lot of these statistics come from the ACFE report to the nations. So I just wanted to highlight a few stats and trends here. And I think we have one more, and that's on initial fraud detection. And so this is how, you may have seen this before, that tips are the number one way to initially detect fraud. It doesn't get into how the tipster necessarily uncovered the fraud, so I find that piece a little bit lacking in this chart. But we still, of course, want to have a mechanism to receive tips, which is why I always recommend having a hotline. And perhaps the anonymous nature of that helps facilitate tipsters. So I think some of these categories should really be higher, especially the internal ones like management review, document examination, account reconciliation, and even by accident, which is just sometimes how it happens, and then somebody decides to do something with that. So maybe that could be then they report a tip and it can be investigated further. So we have our first poll question, and this will pop up here. Has your organization ever experienced fraud? And so I'll give you a quick hint here. No is not really an accurate answer here because fraud is so prolific. The likelihood that your organization has been affected in some way in the past or even currently is very, very high. So the more likely answer is unsure if you don't know about it. So a good 50%, it looks like so far, have experienced some sort of fraud. And we'll give about a minute for these poll questions to make sure everybody gets a chance to respond. Okay.
So next I'm going to go through auditor responsibility. We all know one of the first thoughts that goes through everybody's mind when fraud does occur is, why wasn't this caught earlier by the auditors? So in this next section, I'm going to go through, what is really the auditor's responsibility as part of your financial and your compliance audit, and then talk about what are some barriers as part of the audit process in finding fraud. So what is auditor's responsibility? A lot of you have probably heard this through the audit presentations to the board, and this is also listed out specifically in your auditor's report within your issued financial statements. But the auditor's responsibility is to express an opinion about whether the financial statements prepared by management with board oversight are free from material misstatement, whether due to error or fraud, are they fairly presented, and do they conform with US GAAP or your other reporting basis. The auditors are also responsible for reporting any significant deficiencies and material weaknesses in internal control over financial reporting. And that's the area that I think is really the most important in the reporting aspect. This is where we would have conversations about any significant segregation of duties issues, any significant material misstatements within the financial statements as well would be reported within that report, both to management and to the board as well. And that's something that should be reviewed, kind of heavily throughout the year in determining, have you taken the steps to address those weaknesses that were reported as well. And then the auditors also are responsible for communicating any specific matters to the board or the stakeholders. So that's typically done at the conclusion of the audit, whether it's through the presentation to the board or through the issued letter at the conclusion of the audit. And that's where we talk about, any significant accounting policies, any new significant estimates. We also would call out any disagreements that we had with management in the audit process. And then we also would take that opportunity to talk about any general suggestions. So maybe something that didn't rise to a level of a significant deficiency or material weakness, but is a suggestion for strengthening your internal control environment. Then what are the barriers to finding fraud in the audit process? So as Kate mentioned, the inherent nature of fraud is specifically looking at intentional concealment. So really the audit tests are designed to uncover errors in the financial reporting process and aren't really sufficient to catch calculated financial manipulations. Because we do have the risk of management override of controls and management's ability to manipulate accounting records. So when those overrides happen or the manipulation of accounting records happen, the auditors aren't specifically looking at that in the audit evidence. We're looking for errors and were things properly recorded. And then audits happen at year end. So really we're looking at your activity for your statement of financial position at a snapshot at a point in time and looking at some of the activity that kind of straddles at year end. And then your statement of activities, we're typically doing samples of activity that's happening throughout the year. And so when you think about fraud prevention and detection, that really needs to be happening internally on a day-to-day basis through those internal control procedures that you have in place. And then another barrier that we also talk about, kind of as auditors in our planning process as well is, as auditors, we typically have one or two main contacts in the audit process. Typically it's, talking to the accounting personnel, and that's the main person that we talk to and send all of our questions and requests through, and then they typically facilitate that off to the other departments. So that's something that we talk about in the audit process is trying to get in contact with people outside of accounting, and maybe we can make those interactions directly with operations or other departments as well. But typically for, an efficient audit on your end, it's typically running all through the accounting personnel. So really kind of missing that opportunity to interact with operations and other departments, where a lot of times that's where the fraud can occur outside of the accounting department. So then what is the auditor's role? So throughout the entire audit process, your auditors are exercising professional skepticism. So we would alert you to any conditions that may indicate a possible misstatement due to fraud, but we are not specifically looking at transactions to determine if it's fraudulent or not. Rather, we're looking at it for errors in recording. Auditors also critically assess audit evidence, like I said, to determine if there's an error in the recording process as well. And then we also talk in the audit process about any biases that we may have or that may exist on the client end as well. A lot of times the biases start developing over long-term relationships with clients, and so that's talked about in the planning process, designing audit procedures to really overcome some of those biases. And then the auditor's role is also to have a really robust risk assessment process. So during the planning process of the audit, we look at what are some identified areas that are of significant risk of material misstatement. Every single audit has some that are very basic that roll over from audit to audit, but then other ones adapt based on the different organization and different activities that you have, and that could change year to year if you have new activity one year. So, through that risk assessment process, we design audit procedures to be able to gain comfort over the reliability of that information and to be able to issue that audit opinion. And then in addition, we are required as part of the audit to have some unpredictability procedures really to address some fraud risks and do some fraud tests. Some of those tests that you may see in your audit process is journal entry testing. That should be done every single year in the audit process. You don't know what journal entries we're going to be selecting, how we make those selections, and doing, asking questions as to why things are recorded, asking for the support for that as well. And one of the key things is looking at approvals of journal entries made to support that somebody outside of the person recording it has also reviewed it and approved it as well. An additional test that could be done that I've seen in my 15 years of auditing is looking at vendor listings, and not just looking at the vendor listing, but comparing from one year to the next and what vendor may be new, doing a sample of some of those new vendors and looking at what the approval process was for adding them into the vendor system, also looking to see if they're debarred vendors, and also looking at significant swings in transactions happening with specific vendors from year to year. And then also one of the tests that I've done is looking at misspellings. So are there vendor names within the system that are very, very similar, but maybe, there's a period at the end of one. Those are some additional unpredictability tests that we can do in the audit process.
And I can, if you go back real
No, go
quick,
ahead,
I
Kate.
can talk about that graph real quick, or the chart
Oh, sure.
on the previous slide. There we go. So the graphic here reflects some of those conditions that would make an organization susceptible to fraud. The largest one, of course, being a lack of internal controls, which obviously leaves, opportunity wide open for perpetrators. And I've had several of those types of investigations. But about the other half that are shown here are issues that your organization could be facing, even if you have what appear to be robust internal controls on paper. Oftentimes what happens in practice differs from what is documented. So things like overrides of internal controls or just circumnavigating certain controls because of too much of that proverbial red tape. So we want to try to strike a balance to ensure controls are both manageable to the organization while still being effective. And Larry, while I'm interrupting you, there are also a couple questions that came up. So one of them is from an earlier graphic I had shown on why financial statement fraud is one of the highest in terms of monetary loss. I don't remember exactly what the ACFE report would have said, but my guess is because it's easier to justify the amount that you are adjusting something because there's necessarily not a victim in that, and it's easier to say get that under the radar or explain it away as an error, or we have this new accounting principle or something like that that we're trying to address or something like that. So I feel like that is because you don't necessarily have a victim in that type of fraud, that it's more likely to be a larger amount. Another question is, are there any software or use of AI that could find or suspect fraud? There certainly is. I don't have like a specific one that I would recommend to you necessarily. We are also working on trying to incorporate more AI into our practice. I currently use a tool that helps me extract information from bank statements using AI, so it can kind of read canceled checks for me and kind of put it into a spreadsheet. So that's less of me manually doing that now. So that kind of helps improve efficiency, but yes, it's definitely out there. And then finally, the last question we have so far is, are you talking about hacking into an organization's system to steal money that way, or are you talking about fraud from internal sources? A lot of the fraud is from internal sources. That's the majority of asset misappropriation where theft is happening. Hacking into a system, cybersecurity is a whole different category of specialists, and they can help with things like penetration testing. And so that is services that are offered. But a lot of the fraud that I'm talking about is mainly coming from employees, at least that I see.
Yeah, unfortunately, I've actually seen an increase in the cyber attacks as well, causing fraud. I had, an organization have um, fraudulent emails come through asking for
Yes.
payment.
Mm-hmm.
Um, and I've had a couple organizations have their entire system frozen, and having to work with the
Mm-hmm.
FBI on that as
Sure.
well. So unfortunately, there's been an uptick in that as well.
Yes, like definitely those electronic payments getting sent where they don't belong is another big one.
Yep. And I'm the treasurer on a association, and I actually had one of those come through, and I could tell, and that's part of being skeptical. And how is that email written? I could tell that
Mm-hmm.
that email was not written how the personality of the president would write it.
Sure.
So I had questioned that and sent him a text, and then promptly deleted that email. So, having that skepticism when you have those
Mm-hmm.
emails come through as well internally.
Absolutely.
Okay, so then what are the auditor reporting requirements? Looking under the government auditing standards, when identified or suspected fraud is considered material or pervasive, relevant information should be included in the report on your internal controls over financial reporting and compliance. However, if a fraud is not material, but we still feel that it merits the attention of those charged with governance, auditors should provide written communication of the relevant details to the appropriate officials of the audited entity, typically done via the management letter. I also would, I know I would, and others within the firm would have a phone call with the board as well. Usually, when we find out about it, have a phone call with the board president or the board treasurer so that it's not a surprise, and typically have management involved in that conversation ahead of meeting with the board and sending that management letter as well. So then what are the auditor reporting requirements specifically under the uniform guidance? So it's looking at your compliance, your federal awards. So auditors must report any known or likely fraud affecting the federal award as an audit finding in that federal award section of your schedule of findings and question costs. An auditor is not required to publicly report information that could compromise any ongoing investigative or legal proceedings. So we, don't want to do anything that would impact anything that you have going on as you're investigating fraud that you've become aware of. And then we also aren't required to make any additional reporting when the auditor is able to confirm that the fraud was reported by the organization, as that is required under government auditing standards for that to be reported by the organization. And then we may also consider, even if you took all those steps, you did the reporting, we may also consider any findings specifically over your internal control deficiencies related to the incident that have not been corrected. So if you have taken steps to correct those internal control deficiencies, we would need to be able to see evidence that has been put into place and it's running efficiently as well, and how have you designed it. And so if we cannot do that, we would consider if there needs to be a written finding for specifically over your internal control environment. And kind of circling back on, thinking about ongoing investigations and legal proceedings, I know that can be pretty touchy if that's going on in the middle of the audit process. So, if that is happening, the auditors may consider if we need to withdraw from the audit, but more than likely, we'd think about deferring the work. Do we need to pause the audit while you investigate further to see the pervasiveness of the fraud and move forward in those legal proceedings? And then also, looking at reporting, if we did report the fraud within your financial statements, the auditors should make sure that only information is being reported that is already public knowledge, so that we're not including anything in the report that the public isn't aware of yet, that could impede the investigation or those legal proceedings.
Okay, our next section is on fraud risks for nonprofits. So the majority of fraud that we will see, which falls under that asset misappropriation category, does not differ from industry to industry. However, there are some conditions that can make nonprofits susceptible to fraud, and there may be some schemes that are specific to the industry. So that's what we'll be highlighting here in the next couple slides. It is still important, however, to understand fraud schemes in general, which is why I also always recommend some sort of fraud prevention and detection training. So first is culture, where a nonprofit might be more focused on the mission and the goals of the organization over, say, the financial side of things and the robust internal controls. They could be more trusting or less skeptical of the employees. How willing is someone at any level really to push back or say no, or I'm not going to improve that, even from a superior. Resource constraints, of course, always. What is the ability to implement effective internal controls and have that proper separation of duties? Is there any reliance on part-time staff or use of volunteers who may not be familiar with their roles and responsibilities in internal controls? An organization might be less likely to have sufficient backup when somebody is out on vacation or family leave or something like that, causing even more strain on segregation of duties. And then what is the composition of the board? Are board members more suited to assist with fundraising instead of providing oversight? What kind of skills, knowledge, and experience do they have to help oversee the financial operations and control environment of an organization? And then also, how involved are they? Are they asking questions about financial matters? Going through, do they understand what they have to approve in their whatever frequency of meetings that they have? And are they getting fraud training as well? And then finally, unfortunately, there are harsher impacts to a nonprofit's reputation and the risk of losing donations should a fraud become public. So a nonprofit organization is less likely to prosecute fraudsters due to that risk, which means that they can then move on to the next unwitting organization. So next here we have some schemes that are specific to nonprofits, though again, still a little generalized. The first one being skimming of the receipt of unexpected revenue, aka donations. Donations can come in at any time, and so it's not like we have a control to say, our accounts receivable is expecting these revenues, and so we have some way of tracking them. But donations can come in at any time. So in this instance, if, say, you receive donations in the mail, are two people opening the mail to help compensate for that? Or can we at least rotate who is helping to open the mail to cut down on the risk? Or even using a lockbox so that it goes directly to the bank and they just deposit it into the organization's account. Or if you're not obviously receiving many donations in the mail anymore, this might be something you are less likely to implement. But again, if you have, say, your donations director, they could be directing people to send money to the wrong place. And how do you prevent that? And what kind of donor management software are you using, and how are you tracking those touches to your donors? Second is getting into that financial statement misstatements. And here we have the manipulation of the allocation of functional expenses. So there is that public expectation that only a certain percentage of expenses should go to overhead versus programming. Whether that's warranted or not, it does create pressure on the organization. And so there is pressure to justify what organizations are spending on, like salaries, for example. Um, Next is the overvaluation of in-kind contributions. So that's, pressure to justify that an organization is doing better than it really is. And then, the public is often concerned with like your sham nonprofits and whether they're making the right choice with their donation dollars, which may cause some incentive, to make an organization look like it's doing better than it is, or it, has the right mix in that allocation of functional expenses. Next here is conflicts of interest. With vendors, grant recipients, board members, whomever, a lot of board members are used for their connections, perhaps. Maybe they have a financial interest in something, or they, know somebody who can do this for the organization. So having that skepticism, asking those questions, is this transaction truly beneficial to the nonprofit as opposed to maybe another party that could offer that service, kind of thing. And finally, beneficiary schemes like falsified eligibility, fictitious beneficiaries, or false claims. I actually have a false claims client right now where I have a nonprofit that is offering a rebate program to get your a car repaired. And so they'll say, we'll give, eligible recipients can get a rebate up to a certain amount if they go to a repair shop. And so what they're finding actually is it's not the customers necessarily who are falsifying their eligibility, it's the auto shop that is submitting false claims. And so they will say, yes, we repaired this vehicle, all the way up to the max amount of the reimbursement. And then they'll submit those. And so we're seeing trends in the claims from, looking at the population of claims as a whole, and we can see these specific shops that are consistently submitting claims that are at or above the rebate amount that the organization is offering. And so we're kind of doing like you have to provide, like here's a sample of transactions and please provide all the support for that. And we're kind of working on that with them. So that was just an example of false claims that I've had recently.
Okay. And then we're looking at some schemes specific to your grants. So, looking at double dipping. So double dipping is the submitting of the same expenses to multiple grants or funding sources. We saw some of that was heavily talked about with the PPP and the ERC and all the federal grants that were existing at the same time. If you claimed some payroll under PPP, that really needed to be backed out from your other federal grants as well to ensure that you didn't double dip and get reimbursement from both PPP and one of your existing federal awards. Another one is looking at non-compliance. So really looking at, did you report that you met some of the reporting requirements, your performance requirements, or like Kate talked about, in-kind. A lot of grants have matching requirements that you can use your in-kind. Did you overvalue your in-kind within the financial statements to support that you met those requirements, but you actually didn't? So you were really non-compliant to the grant to meet that and receive those reimbursements. Another one is looking at conflicts of interest that Kate touched on. So really less than arm's length transactions, that'd be purchasing goods or services or hiring individuals from related parties. I've seen that from, hiring family members of somebody high up in an organization, using a specific vendor because they're the husband of somebody on the board. Those are all examples of those less than arm's length transactions. Another one is looking at undue influence. So looking at your sub-grant award decisions and your vendor selection process. Was that made without a fair and transparent process, or do you have a good procurement process in place to be able to make those decisions and vendor selections as well? And then another one is looking at misrepresentation. So providing false information or failing to be able to support the use of the funds or inflating costs. One thing that we've been talking about a lot lately is the indirect cost rate and the pooling of the costs. Do you have the correct pool together to be able to charge those to the grants? And did you stop that at the max amount of your administrative expenses? Or are you spreading it across all the different grants and you're getting reimbursed in excess of the actual costs that you do have? So some additional fraud risk factors for grants, looking at incentives or pressures. One of the things that we saw in the last year is some administrative changes. So do we have upcoming or expected changes in laws or regulations, such as the executive orders, that may negatively impact the organization's financial health or profitability? Or do we think that there's going to be a government shutdown, and so you're going to run out there and do an advanced cash draw on your grant or charge expenditures that maybe aren't really eligible under those different grants, but you're trying to max out your grant agreements. So those are some incentives or pressures. And then also looking at aggressive budget or program goals. Have you set too aggressive of a budget or a program goal that has given some pressure to be able to meet that and be able to max out your grant agreement as well? Another one is looking at a combination of fixed price and cost reimbursement grants, and those may create incentives to reallocate expenditures between the different programs that you have, between the different grant agreements, to be able, again, to max out the use of those funds from the grantor, or manipulate your accounting entries as well. And then another one, that we've all been talking about for several years and that's been impacting, since a little bit before COVID is declining revenue and increasing expenditures, creating financial pressure and incentive to apply maybe some non-program costs to federal awards. So again, that's incentives or pressures to max out those federal awards, get those additional funds, and that's why it's really important to have those procedures in place to make sure that the expenditures that you're charging to those awards and requesting reimbursement for are actually eligible and are only being charged to one grant. Okay. And then another one is looking at opportunities. So the other part of the fraud triangle, a significant increase in funds without the organizational structure to support. So we saw a lot of that during COVID. A lot of federal awards were flying around, and some organizations did not have the structure available to support those funds, but again, wanted to be able to use, the increase in funding. So that created some opportunity to have, some fraud within the organization because you didn't have the structure in place to be able to support that. In addition, looking at, appropriate segregation of duties, ensuring that you have the proper checks in place, in areas such as eligibility determination. And I think, a good one is talking about what Kate just talked about with her false claims. Do you have the appropriate checks in place to ensure that those claims are actually appropriate? Another opportunity is looking at legacy or underperforming accounting or information systems, that could really compromise or limit the effectiveness of your internal control environment. That's an increased opportunity for fraud risk. Right. And then to bring, full circle on that fraud triangle, we have attitude or rationalization, specifically to grants. So, thinking about disinterested attitude by management regarding strict adherence to a federal award rules, that cost, that's fine. We can just charge that to the grant. The grant might not say that we can charge it, but they won't notice it. So we'll just charge it to the grant so we can max out that award. I stress the tone at the top, making sure that management and the board has the right attitude. They want to adhere to the cost principles in 2 CFR and also want to adhere to what the grantor's wishes are as well. Or do you have ineffective or non-existent communication or means of communicating your values, your ethics? Do you have a conflict of interest policy, a code of conduct? Is that looked at more frequently than just at onboarding of the employee as well? Making sure that you have, frequent existing communication on those values and ethics. Or do you have fostering a perception among the staff that they are entitled to program benefits due to receiving below average compensation? I know Kate touched on that before as well. So when you do have that attitude of entitlement to those benefits, that is an additional risk in the fraud environment. Okay, I think we have our next polling question.
What fraud scheme are you most concerned about impacting your organization? An employee cutting checks to themselves or a false vendor, theft of donations, manipulation of financial statements, or abuse of company resources, such as excessive spending. While everyone's answering that, Larry, a comment came up. If you could mute your mic while if I'm the main person talking.
Oh, sure.
Just because I think they're getting low feedback. Okay, again, just a minute to answer that question. It looks like the majority are concerned with the abuse of company resources, which absolutely makes sense. That is the thing probably most likely to occur. Okay, the rest are pretty even. Okay. All right, next, case studies. Okay, so I have 4 examples for you of investigations that I've worked on. They are all audited entities with internal controls, so I'll also discuss what failed. So the first 2 examples are long-time frauds, both of which occurred over 20-year plus periods. So the first one is regarding payroll. So we have a part-time payroll clerk that was involved in processing payroll that would then issue themselves manual payroll checks. And so it was concealed because it, 1, wouldn't come up in the payroll report, and 2, it wouldn't come up in the AP check register, obviously because it's coming from a different bank account, or maybe not necessarily a different bank account, but it's not through the regular AP process. However, not only did I request the bank statements, but I requested copies of the canceled checks. And very obviously, right there, looking at the images of the copied checks, is that person's name written out on all these extra checks. Had somebody requested those because they weren't automatically provided with the bank statements, they would have found it right away. And so several issues here. Obviously, this employee had too much access to the payroll process. They were both processing the payroll, and then also issuing checks, obviously a concern. So they didn't have oversight there, too much access and no oversight. And then bank statements and bank reconciliations were prepared by somebody who did not really have any training on doing this. And so I think they kind of just followed the prompts in the accounting system and didn't really take it particularly seriously. And so the employee was able to fund these checks to themselves by not paying payroll taxes to the IRS. And so if you're wondering where was the IRS, they would come knocking every few years and say, hey, this payroll form, I think it's the 941, I want to say, we have some questions on this. That employee would jump in and say, I'll handle it. They would maybe pay some fines and fees, and the IRS would be gone for another few years. Finally, there was an IRS agent that was like, all right, we really need to investigate this further. And once we started pulling those bank statements, they finally realized that, hey, maybe we should look into this a little bit more. So that ended up being, over the 20-year period, about a $12 million fraud. Next one is a current client I have. This is actually a government entity. They have obviously multiple departments. It's like a county, so they have all these departments and divisions. And an office manager in one of those divisions set up a bank account essentially in the organization's name. They used some forms, they might have forged a document or two, but this allowed them to then take checks that came in the mail that were written out to the entity and deposit them into this false bank account because they didn't have to change the name or anything like that. And so that since they were in charge of opening the mail, when certain checks would come in, they would just endorse them. They even got an endorsement stamp and deposit them into that bank account. And when that wasn't enough, there were two more schemes that this employee was involved in. The second was that they would then cause vendors to be overpaid. So they would pay an invoice as normal 1 month, and then they would resubmit an invoice a second time the next month to overpay them. And then they would contact the vendor and say, oops, we overpaid you. Can you send us a refund check? That refund check would come in the mail, and the employee would divert that and put that in their bank account. Third scheme that they had was they then created a false vendor. Now that they've become familiar with how vendors are paid in the system, being a long-time employee, they created a fake vendor. It was very easy to do. No due diligence was done on this new vendor. They kind of used it as a sub vendor to an umbrella organization, just saying like, hey, we have this new program under this vendor. You can go back to that slide, Larry. We have this new vendor, or we have this new program under this umbrella vendor. Can you just add this vendor's information? And it had different payment information. Nobody questioned that. So there was a lack of due diligence and review of vendor management. So vendor management is a lot of the area where I make a lot of internal control recommendations. So anyway, they were able to set up this vendor and then submit invoices for payment, which would then go to their bank account. So over a 20-year period, this one was about $1 million fraud. And since it's a government entity, they did get in extra big trouble because they are, the state's attorney is involved, and they've charged them with things like money laundering, forgery. I think it's misconduct of a government role or something like that. So they have a lot of charges against them. So okay, so example number 3. This one here, number 3, was a park district where an employee that was the director of building and grounds was using their company credit card to make personal purchases. And then when they would submit like their monthly package of credit card receipts and invoices, they would manipulate those and make edits to essentially the PDFs, which is very easy to do these days. They would just essentially rewrite a line of the receipt to show that they had purchased something else and submit it that way. So one thing that was a concern here was they had ineffective oversight where the program director was approving their credit card purchases. And so this is a program director not understanding what repairs and maintenance needed to be done, and this employee would just explain away, we need, these parts for this engine, or whatever it was. And so that the program director was kind of just taking them for their word and would let them go. And then also there was acceptance of payment receipts, very stingy receipts, rather than a detailed invoice. And so this person would essentially just submit something that maybe had the vendor, the date, and the amount, but it wouldn't necessarily be itemized, or it would, be a very lackluster description, that kind of thing. And so especially for vendors that are unusual, so this person was often on auction websites, eBay, auction sites all over the country. And so one of the things that we had done was I went to those auction websites and tried to pull what was essentially an original invoice so that I could compare it to what they actually submitted. And so that was kind of the whole way that we did this investigation was trying to obtain original receipts to compare to what this person had submitted. And so going on the auction sites, because they will list oftentimes historical auctions, and we can kind of see what was actually purchased. They had an Amazon account, an eBay account, a PayPal account. And so some of these we were actually able to get their login information and pull like the purchase history. So that was one way that we were able to kind of compare and then identify so that we could quantify the amount of the theft here. So while credit cards are obviously very useful and convenient, there are some risks, in circumventing essentially that traditional AP process. So we want to make sure, we are blocking certain types of vendors. We are making sure if an employee is, making personal purchases, that they are repaying the organization and they're only doing it like once before we revoke those credit card privileges, and just following through on revoking credit card privileges. And so, and then of course, you want those detailed receipts to go along with. So those are a few things that could have helped there. My final example is another pandemic tale. This fraud happened very early on in pandemic times. It was a charter school and they were sending kids home, for remote learning. So one of the things that they were purchasing were things like Chromebooks and tablets to send home with the kids. So the director of IT decided to pad those expenses, and he created his own vendor and submitted invoices for the same thing, essentially duplicating exactly what they were purchasing, with obviously not receiving any computers or tablets or anything like that. So he took advantage of, a difficult time, that transition from working from home, like at the very beginning, and having kind of those relaxed policies, or just trying to figure out how things were going to be approved in a remote environment. And then of course he knew what the types of goods and services that this nonprofit needed, what vendors they used, and he also had the ability to approve transactions too. So again, there we also had limited vendor due diligence. If a vendor is using a PO box, always try to gather more information. You want to make sure that there is a person on the other end of that vendor. And then, of course, approving payment for goods without confirming the receipt of those goods. So having a way to do that. And then again, oftentimes what we'll see is people are approving invoices in a vacuum, like you're just looking at that package of invoices at that moment and maybe not looking at the history of what you've already paid that organization, that vendor. So just or comparing it against a budget or something like that. So being careful with how things are approved, especially in a remote environment. We've adapted quite a bit since then, but still always, a concern.
Okay. Kate had real live examples, and I just wanted to put out a example here that really kind of talks through two different scenarios to get an understanding really on reporting requirements, what would change and what would be reported as part of the audit, and what the auditor's responsibility is. So for background, program director uses the organization's credit card or cash app, such as Venmo, to buy gift cards to provide support to families in need for immediate assistance. Some gift cards are distributed to eligible families, and some gift cards are kept by that person for personal use. The program director either does not submit detailed receipts, submits fictitious receipts, or provides actual receipts, but then personally uses the items. So in scenario number one, management discovers the fraud and contacts the appropriate agencies. Law enforcement investigates, management informs the granting agency, and then the auditors are also able to confirm that this reporting happened both to the granting agency and to law enforcement. So if those things happen, what would the auditor's responsibility be? Under uniform guidance, we are not required to publicly report that information as it could compromise your ongoing investigation and legal proceedings. We also wouldn't make any additional reporting because we were able to confirm that the fraud was reported under the requirements of the government auditing standards. It does require you to make that reporting. And then, as I noted before, we may still issue a finding if we feel that the internal control deficiency has not been corrected that led to the fraud within the organization. And then taking that same background, but looking at a different scenario. So in this scenario, management did not report the fraud to the appropriate agency. Management didn't report it due to concerns, as Kate mentioned, on public perception and what the potential impact would be on meeting your fundraising goals. Instead, management performs an internal investigation and negotiates repayment with the fraudster in exchange for not pressing charges, and has that program director sign an NDA. And then the auditor becomes aware of this through a discussion with management and review of the board minutes. So then in this scenario, what would the auditor's responsibility be? If we did not see that it was reported to the board, we would communicate the incident to the board of the directors if they were not otherwise notified. We also would relook at our risk assessment procedures as part of the audit to determine if we have any additional procedures that we need to do to determine if other programs were impacted and not just the program that this was charged to. And then we also would report findings both under uniform guidance and under the government auditing standard requirements as well. So I think it's good to kind of like bring that full circle and see how, these different scenarios, how that would impact your audit and the reporting within your audit report as well. So, what is the grantee's responsibility when you have identified? Yep.
I'm going to interrupt you one more time since we only have 4 minutes left.
Sure.
Rachel wanted to launch the last poll just to make sure that everybody gets credit. So let's do that real quick.
Okay.
Okay. What do you feel is most important for your organization to enhance its internal controls? Implement a fraud hotline, offer fraud training to employees or the board, conduct a formal assessment of internal controls, or ensure there is insurance coverage for employee theft. So the last maybe 2 slides I'll do are some recommendations I have real quick, which kind of touch on these poll questions that we were about to get to, and then we'll touch on maybe a couple resources since we only have a few minutes left. Okay, it looks like the majority of you are conducting a formal assessment of internal controls, which I highly recommend. That is something that Sikich can offer, not only the forensic services team, but we also have an internal audit team. We often work with each other on assisting organizations improving their internal controls. Okay, Leary, would you mind jumping to slide 35? Okay, so if I were to give you a 1-page snapshot on the things I would recommend on enhancing your internal controls is 1, ensuring that your organization has an ethics policy and code of conduct. We want employees to know that they are being held to a high standard and that they are stewards of an organization's resources. 2, offering fraud training for all levels of employees and the board. Again, reiterating, the fraud prevention and detection should be happening on a day-to-day basis. So people need to know what they are looking for and to be able to say, hey, this doesn't look right. Because of my fraud training that I have, I wanted to bring up this concern. 3 is implementing a fraud hotline and incident management protocol. And so when you have the hotline to help facilitate tips, then you have that incident management protocol to help respond to either an incident that came through the hotline or another way, just so you know what to do when something goes wrong. Again, we can help you with that. This is not necessarily an internal control, but obtaining insurance for employee theft that can help you recover some of your losses. Ensuring that senior management and the board are committed to an effective control environment, your tone at the top. Obviously, conducting a formal assessment, which most of you agreed is something that your organization needs. And then finally, addressing findings and suggestions from that annual audit. You want to make sure that you do make those adjustments. Again, but we're not relying on the audit as a control for fraud. It can help prevent fraud, but again, the organization needs to be having, like, say, that assessment of internal controls to make sure they're working efficiently and effectively. Last thing we'll take a look at is slide 43, please. Again, all of these slides will be available in the handout, but I'll just get to it real quick before we exit for today. Some fraud training resources. That Association of Certified Fraud Examiners offers CPE. There's a nonprofit risk management center. And then the AICPA, state CPA societies, they all offer some sort of fraud-related CPE. And then, of course, we can do training seminars for you, just like this. Leary, do you want to go over maybe the GOA for anybody who can stay for a smidge longer?
Yeah. Yep, I have a couple links in here specifically from the Government Accountability Office. So you can click on each of these links. These are different tools that you can use for setting standards for your internal control environment, activities to prevent and detect and respond to fraud, doing a deeper dive into specific fraud schemes as well, and then also where on FraudNet to report any suspected fraud, waste, or abuse. And I just want to say a thank you to everybody for coming today and, download the slides so you can look at the slides that Kate and I didn't get to as well. And if you have any questions, we're here to address anything. And obviously, if you unfortunately come across any fraud, feel free to reach out to Kate or I as well.
Yes, always happy to answer questions or assist with anything. So I always maybe get a little long-winded with case studies because those are my favorites. So
They're the most
one of the
exciting.
questions was, what career path do you have that led to you being involved in investigations? And like I said, I was an auditor before, and then coming to Sikich, I worked under a former FBI agent and also a former inspector general that worked with the city of Chicago. So there was a lot of experience and mentorship that I was able to get very early on when I started doing forensic accounting. And so now, yeah, now I just have a lot of, on the job training with all these case studies, all these examples that everything is always different. So that keeps me on my toes. Okay, again, thank you so much.
Thanks, everybody.